All right, everybody, I'm going to get right into this with some key information from Carson Wealth Management on the markets with Iran situation going on. We got oil above $100 a barrel. And then also want to talk about another impact, the midterm elections on the market. And I got some great charts on this. And at the end, I'm going to wrap it up, kind of talk about what we strive to do for our clients to help strive to keep the cortisol levels low during times like this, but still help them pursue the lifestyle that they want and do it with the least risk possible out there. So I want to show you what we do with that. Let's take a look at this first by Carson Wealth Management. Their thoughts on the market currently. This was just put out. I think it's some great info. And let's take a listen to this right now, and then we'll get into the other stuff that I was mentioning. Here we
And
go.
that's where all this is coming. So let's kind of put a bow on things. Let's just high picture from a market's point of view. Listen, we understand the drama, the headline risk, the terrible things that are happening overseas, the volatility we're seeing in our oil markets, the volatility we're seeing in our equity markets, and even more so equity markets around the globe. We've actually seen, Sonu, since all this started, U.S. has been about the strongest market. Now, yet we're down a little bit, but actually a lot of other countries are down more. So it's like maybe a little bit of a safety trade to the United States. Maybe the economy slows down a little bit. Listen, well, that's not our base case, but what happens historically, you have investors reach for growth when the economy slows down. We are a growth heavy, kind of tech led country, right? So tech has actually done a little bit better. Remember that software big sell off we had, a month ago or so? We talked a lot about that. We've seen strength from those areas, but I'll put it like this, Sony, to let you finish it up. The time we're doing this, the Dow Jones Industrial Average is up 10 months in a row. All right. 10 months in a row is one of the longest win streaks in the history of the Dow. It started way back in 1896. We were probably due for some volatility. Heaven forbid we're due for a down month or two. I mean, that happens, right? And again, we're right in that spot where this headline risk is there. The concerns are there. We're not minimizing them at all. But we still think we're going to get through this. We still think we're in a bull market being led by higher earnings, being led by higher profits, being led by higher what's where I'm looking for productivity, right? We still have probably a dovish Fed. We'll talk way more about the Fed soon enough.
Yeah, huge points there because we literally, if you look at the marketplace right now, the S&P 500 is only down about 2.9% year to date through all this craziness. Now we were up, pretty decent. We pulled back some, but wow, if you think about that, and that's their point is we're coming into this in a strong environment, economic wise, AI and everything. But listen to more what Ryan has to say.
We'll get back to that stuff, but there are still a lot of tailwinds to this bull market. Clearly, what's happened in the Middle East has put a pause in that. But again, we've had a heck of a run, so maybe the market was due for a pause. So, how do you want to finish up the second ever?
All right, so that's what I wanted you to hear from Ryan Dietrich. Now I want to show you these charts that I was talking about, which are just very critical when you take a look at these. Okay, so let's take a look at this. Huge chart, and I love charts, you know that. And this was put out by LPL Financial. This is actually a few years back, but it's so apropos to right now if you take a look at everything. You literally, if you look at the world events historically when it comes to the impact on stocks, geopolitical events, major, such as Pearl Harbor attack back in 1941, it dropped 3.8%. The total drawdown was 19.8%. And then it took 143 days to get to the bottom and 307 days to recover on that. That's the worst that we've ever seen. Obviously, that was World War II. Then on literally in New York City impact by the 9/11 attacks, down 4.9% when it happened. Total drawdown was 11.6. The bottom was 11 days, 31 days to recover. So that was pretty rapid after you got things under control and kind of figured out what's going on. Cuban Missile Crisis, all these out here. Iraq's invasion of Kuwait. Obviously, we got involved in that. It was down 16.99 or 16.9%, 71 days to the bottom, 189 days to recover. So when you look at all these events down here, the average total drawdown, 4.6%, believe it or not, through all these different crazy things. 19.7 days to the bottom, 43.2 days to recover. Now, I can't guarantee that's going to happen here, but if we get obviously some resolutions, the bombing strikes stop, We feel like there's, progress. The Strait of Hormuz is opening back up. We could see some pretty rapid deployment of capital again back into the markets. Now, the other major thing going on right now, guys, is the midterm elections. And ironically, these particular years during the midterms tend to be not so good years because we don't know the certainty what's going to happen with the elections. That's going to impact Senate, Congress, all that kind of stuff. But if you take a look at these returns, typically the markets bottom about 17% on average during the midterm elections. And that's kind of where, we're in this point now, but that's usually later in the year. So maybe we're getting this pullback like Ryan's talking about. We're due for one. For 10 months in a row, we've seen the Dow go up. But a year later from the bottom, we see the markets have historically ratcheted up pretty big, the lowest one only being 8.7% a year later, but on average 32% on a positive side. So maybe once we get through here, we see the markets rebound nicely if we get obviously through all the midterm elections, later in the year, what we might see. So can't guarantee anything, but historically, this is a pretty good track record of being positive. Literally every 12 months later after a midterm election. And maybe if we're through with the Iran situation, that's kind of subsided. Now you get through the midterm elections, who knows what we could have here. This is just more the actual year after. So that following year, the third year is 14.7% is the average on that third year of the after midterm elections. And then the reason I bring all this up, from when we strive to help our clients manage their portfolios as they get closer to retirement or in retirement and pursue that lifestyle that they want, we're striving to do that with the least risk possible. Because the last thing we want to have happen as we see a 30 or 40 or God forbid 50% decline because it takes a lot to get back to even. At 40%, at 67%, 50%, it takes 100% return just to get back to even, guys. And we're striving to avoid that. And also, just even during every year historically, this goes all the way back to, I think, 1980. Yeah, the average drop of the market every year is up. Intra year pullback is 14%. Most people don't realize that, but that's a pretty big, hefty move. And that's usually when people start getting a little queasy 14, 15, especially 20. You're starting to get phone calls. People are asking about things. You're talking about your friends and neighbors, all that kind of thing. So we strive to avoid that and try to put in different levels of protection in people's portfolios. Like this, obviously got to, if you're going to buy insurance on a property and the beach, you still want that great view. But if there's a hurricane, you're trying to protect that, or you're building it up on stilts to minimize some of the a flood that might happen. But there's this guy called Moshe Milevsky, a professor out of Toronto, is well known in the financial industry, and he did this study that he looked at since 1970. He said, all right, 15% of the time and those months you lose more than 3%. 70% of the months between that time, your return was a -3 to a +5. And then 15% of the months, you earn more than 5%. So what he said, would you be willing to protect against the worst 15 months in exchange for sacrificing the best 15? Meaning you can't get above 5% monthly return if the market went up more than 5%. He says, historically, would you have been better off? And the answer he came out with during all his studies was yes. He said, if you can kind of bracket your returns, avoid the bigger losses, so you don't have to make those up, but you're not necessarily getting all the big gains on the upside. He showed that it outperformed the S&P 500. Now, there's no guarantee going forward, just an observation there that protected growth for the most part had beat unprotected growth in his studies. So we strive to build portfolios for our clients that have different buckets of money with different levels of protection, strive to lower cortisol levels, especially during times like this when there's things going on, you're hearing the worst, all that type of stuff. And the goal of this is that first two buckets of money to strive to have enough money there to cover them for their first 15 years of retirement. And the rationale behind that is historically, even through all these worst case scenarios, that the market has basically never lost money over 15, 17-year cycles, depending on what market you look at, but it's very minimal, if anything, which then allows them to put their head on their pillow at night and not have to worry about what's going on in the market because they know they got that first 15 years of money, sitting there that's protected. But then we get into these other different levels of protection and buckets three, and then buckets four is kind of the treasure hunting bucket. We're striving to find the next Amazon, the next Google, the next Apple, whatever it may be, AI, all that to try and give you longer term growth to outpace inflation. So if you'd like to get a second opinion on your whole financial plan, we give you access to the number one ranked financial planning software in the country, as ranked by the T3 Insider Software Survey from basically the last 2 or 3 years. We give you access to that, and we have a $2,000 promise to start, which means if we can't show you strategies or ideas around tax planning, investment planning, asset protection, so on and so forth, if we can't show you at least that amount, we give you back that money. But we're striving to at least double, triple that out there. So if you like a second opinion, comment second opinion, and we'll reach out to you and get a hold of you. But thank you for joining on. Appreciate it. Have a great rest of your day.